Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On today's program, I thought we should just do it a little bit different than we usually do. I want to bring on Paul Rickard and talk to him about three things. One is the Trump-China battle over rare earths, which really spooked the US stock market on Friday. NASDAQ down over 3.5%. And then I want to talk to him about what stocks look like good value right now. If for example, this sell-off becomes a bit of a pullback or correction, what looks good and what should do well over the next year, despite the fact that the market could be selling off. And then I want to talk to him about the changes of the government on this super tax. They're really back down. And I want to get the details from Paul to see all the changes that are now going to be introduced, which are, as I say, a lot softer than we're expected. And then we're going to talk to Simon Pressley from a company called Propertyology. Simon's been on my show before, really smart guy when it comes to property. And I want to ask him all the questions you want the answers to, either for yourself or if your brother or sister or son or daughter have questions about property, so you actually know what are the right answers to give rather than some of the guesses that many of us use when it comes to property. A really interesting insight from a guy who really lives and breathes properties 24/7. Then after Simon Pressley, I'm going to look at a small medical company in the tech space called Compumedics. We're talking to David Burton, Dr. David Burton, who is the CEO, and David Lawson, who's the CFO. So without any further ado, let's kick off with Paul Rickard of the Switzer Report. Thanks for joining us, Paul.
Thank you, Peter.
As I said in my intro, there's three areas I want to talk to you about. One is the Trump versus China over rare earths issue, pretty big for the market. I also want to talk about the stocks you really like now. So if we work out whether it's still an investable market despite these problems with Trump and China, what do you want to invest in? And thirdly, I want to talk to you about the super tax changes. It looks like the government has lightened off on its threat to be tough on super.
Look, total cave-in. Let's come back to that.
Yeah.
But let's start with China. I think there's a bit in the way our markets reacted today. It didn't start down as much as expected.
It was only 4, wasn't it?
Yeah, the US futures rallied a little bit because Trump came out with a slightly more accommodating comment on Truth Social.
Potato comment, was it?
Something like that. I mean, look, I think there's more to play out here, Pete, and it won't be solved in the next 24 hours. We don't know how China's going to respond, and they've shown before they're not necessarily in any hurry to respond to this stuff. We've got till the first of November.
Yeah.
My guess is this got a little way to play out. I don't think the markets will be quite as forgiving as perhaps the initial reaction in our market. So we sold off it. We opened lower, went up higher, and now we're trading off towards the weakening as the day progresses. So I think we've got a few nerves coming here because look, at the end of the day, 100% tariff, if we even get to that, is going to have some big impacts. So, of course, the different number of categories that the Chinese may impact, the different number of categories that Wall Street may impact. I mean, this can't be good for a long term for American companies.
100% tariff. What's the impact on the US CPI? It's got to be.
What's the impact on the big tech companies in the US if Trump then puts, for example, bans on what they can export to China, in terms of some of their software services? So I don't think it's good for the markets. And okay, maybe he just is all noise and all blows over and we get back to where we were in last week. But you got to say it's probably something will just play out a bit longer, I guess.
So what we've got is an issue that has to create anxiety in the market. It's got to take the tailwind out of a market blowing on AI belief, lower interest rate belief, and now all of a sudden along this comes. So why would anyone be mad keen to put a lot of money in the market right now? So it's going to result in less momentum up, and there's probably some people say, well, I'm going to take profit until I got some good reason to go back in the market.
Yeah, the other thing is starting to happen in the US from Tuesday onwards, of course, is US reporting season. So the quarterly cycle there, we're now into sort of September quarter, and that'll go on for the latter part of all the rest of October and into the first or second week almost of November. So that'll go for the best part of 3 weeks. And that'll provide its own sort of momentum, but we've still got a shutdown. So, yeah, we're now sort of past 10, 11 days where people, that was the original betting, I mean, as to how long this would last. At the end of the day, this can't also be good for the markets. Okay, maybe the Fed has to drop interest rates, but it can't be good medium term for the US economy either, right?
No. Look, there's never been a big market reaction to these shutdowns, but GDP has dropped by around 0.4, 0.5% because of it. So, that will add to interest rate cuts, but it also means parts of the US economy is slower, and it's a slowing economy anyway. And the bottom line is, because of shutdown, we're not seeing how slow it is. We're not seeing the most latest jobs report. So, I'm a very positive person when it comes to the market, but at the moment I'd be saying, personally, I'm going to hold fire. I'm not going to add new money to the market until I've got a bit more clarity. All right, but is this great for gold?
Look,
New anxiety?
I think it's okay for gold. I mean, I think gold's got its own momentum a little bit because of, the allegedly, what the Russians and Chinese have been doing and the central banks have been doing. Okay, we get, on the one hand, some of the fear factors dropped off with, maybe a bit of, I won't say peace in the Middle East, but a little bit reduced tension. But we've got, meanwhile, what's going on in Ukraine with the Russians sort of getting active again.
Even going to Poland to a slight edge.
It sort of confirms the story that the US is a bit dysfunctional, right? And I think that's actually probably still good for gold, in the sense that one of the reasons central banks are buying gold is because they're worried long term that the US dollar is not the place to be, and they want to have reserves for.
Do you reckon that they've increased their gold buying because of Donald Trump and tariffs?
I don't know whether that's been
or is it more debt?
I think it's a function of everything. It's US government debt. It's the Trump government clearly wanting to have a lower US dollar. That's fundamental to all their policy pronouncements. So that weakens people wanting to
hold a low US dollar, so therefore they're diversifying into something that's more solid in value. Okay, that makes sense.
That all goes part of the story. Then you've got the wars that come and go, and his efforts to be the peacemaker. And then you've got this sort of crazy, 1 minute we've got a shutdown, 1 minute we don't. We've got a tariff, not a tariff. And then we've got something else, right?
Yeah. I'm nervous by gold. Yeah, okay, right now. Okay, but are you buying gold? And are you buying something gold at such a high price?
Not. I mean, I bought a little bit of gold the other day. Simply,
yourself.
Yeah, well, I had to, Peter. I just found the pressure.
Gold turns gold. Okay.
And I feel a lot better having done it now. I need to buy any. I think there's actually, although.
Did you cheer when you heard that was fight between Trump and China? You'd be good for my gold investment?
I bought Northern Star because I think there's actually value a bit more in some of the gold miners.
Right.
Than the metal, and particularly in Northern Star. And we showed that the other day on our report subscribers. We showed that the relative outperformance of some of the other shares and the underperformance of Northern Star. Yep. So I think that's where the value is, but that's higher risk. And look, a little bit of gold. Look, yeah, I mean, but you and I have never been huge gold bugs.
No, I hate myself for it.
I missed this rally out, right?
Yeah. Well, yeah, we got it wrong. I certainly, I don't like getting it wrong, but look, the stuff I was in other than gold still did really well. So, and I prefer to be diversified, and I prefer to get an income even when I'm wrong.
You have to be in everything, right? And you're not getting everything right. So, I'm not unhappy.
Yeah, okay. I did look up what the analysts thought of Northern Star, and Evolution has really done really well. On Northern Star, -1%. So there's pretty well, I think the share price is right. Evolution down 23%. All right. And 4 out of 7 were negative for Northern Star. 6 out of 6 are negative on Evolution. So you've got to be careful about what you buy at the moment. Now, I want to look at really good value stocks. For that investor who's saying, there's a lot of nervousness now, what's the companies that are going to do well over the next year? All right.
Well, I don't think they're the banks.
Right.
I do think that there's still upside for our major resource companies,
Yep.
BHP and Rio. But again,
What is this China BHP fight, Paul?
oh, look, I think that's just a pricing issue. They'll resolve that.
Yeah, okay.
China needs the iron ore. BHP needs to sell it. There'll be a deal done at some stage. It may not be great for us as shareholders.
Yeah.
But let's just wait and see how that. I don't think anyone's too worried about that because it's sort of like okay, if well, if they're not worried, if they ban BHP totally, that would be a problem. But I think there's always going to be.
Why is it picking on BHP and not say Rio and Fortescue?
Look,
Is it the price leader in the model?
I think it's largely the price leader. And
Is it because it's got the lowest cost per unit of all?
one of the reasons is it plays maybe the toughest to get. So look at I'm no expert on the intricacies of how the Chinese negotiate, so I'll leave that to BHP or to an expert on that. But that appears to be, I think, the more likely.
Okay, so you still like the miners. Let me throw you some that I think look really good value. I think they're good quality companies. They've been beaten up by the market to a certain extent, and the analysts really like it. First one, NextDC. If you didn't have any NextDC in your portfolio, would you buy some?
Yeah, look, in a pullback, yes. My one caution on NextDC is that if you read the Switzer Report, you'll see today, there's a little bit of shorting activity going on in some of the data center stocks.
Yeah.
So some of the sort of professionals are out there saying this sector's a bit overhyped
Because of AI?
Because of AI. And there's a lot of money going into building data centers. I think NextDC is the best of the operators.
Yeah.
And it's partly also because of the underperformance of Digico, which is one of the REITs.
Yeah.
It was overpriced at the time. So I think this is my one caution, but in a pullback, yes. I think, it'll get, if the market falls off, it'll get sold off.
And this is why I'm bringing it up, because there's a possibility that the Trump-China thing could be dragged out, and we could see a 4 or 5%, maybe even a 7% fall in the market if they get really nasty for a while, okay? And so I want to know what's what. So I'll give you a tick. Analysts say with NextDC, up 25%, 5 out of 5 like it, and the most positive was UBS, that sees a gain of, that's right, Macquarie, 32%. Next one, Xero, XRO.
Yeah, again, in a pullback, Xero's just been under a little bit of pressure because it did a big capital raising. These capital raisings always seem to take longer than you think to digest.
Yeah.
The institutions love it at $176 and then don't want to patch it at $150, $153. I think there's value there, and I think time, again, in a pullback, let's stop. Our tech sector is interesting. It is sort of underperforming the last.
Yeah, and these are the quality ones. Analysts, 38% on consensus, 6 out of 6 like it, Paul, and the most optimistic is Morgan Stanley, up 3%. I like the fact that an American investment bank like Morgan Stanley like it Xero, because as you and I know, they're going to make headway in America. Yeah. And that's where, and so I'm hoping Morgan Stanley knows a little bit more about America than you'll need. Is that possible, Paul? Right?
It is possible. Probably very likely.
Very likely. Okay, next one is WiseTech, WTC. What do you reckon about WiseTech?
Yeah, down in the low 8s at the moment. So this was low 80s, would say, yeah. I did mean 80s. Yeah. This was a $135 stock at some day. So it's come back, with best part of 30-40%. Yeah. So yeah, I think it's starting to look attractive. I don't know what the turnaround story is because there's still the governance type issues, but markets suddenly sort of said not for us, and I think that's again one you look to. It's underlying still has a really good business. Yeah, it's a global leader, and maybe the trade stuff doesn't help it. I don't know. Look at WiseTech.
Yeah, so analysts. Consensus rise for WiseTech is 48.4%. 7 out of 7 analysts like it. And the most optimistic is UBS, up 55%. So once again, the Switzer destroyers, NextDC, Xero, WC, all going to be ticked from the analysts. Here's my last one, CSL.
Yeah, huge fan of CSL. I think it's actually showing a bit of resilience now. It seems to have found a bit of a bottom. It's still going to be viewed as a little bit of a defensive stock, so it'll sell off and may not get knocked off as badly. But it's on a PE now about 18, 19 to 1, which is what we used to trade in the 30s, right?
Yeah.
And compared to some of the other companies that are, pluckers, no. Some of the other companies out there trading on even, CVA's on a PE of 26 to 1, right?
Yeah.
With almost 2% growth, CSL's growing at 6 to 8%. It doesn't make sense to me, so I think there's value there.
Yeah. One day everyone will wake up and say, it's about time we bought it. Consensus view on CSL is up 33%. Let's close that laptop for a moment. And 7 out of 7 analysts like it, Paul. UBS says up 44%. Okay. One last one. This is one that doesn't fit the same bill as those. Right? They're all quality plays that the market building up. TLX Pharmaceutical.
Yeah, that's been a high flyer, really dependent on FDA and other approvals.
Yeah.
Quite a big short position in.
Yeah.
So again, some of the professionals betting that it's not going to work out. A lot of clients have been in and out of it. Some quite burnt because it's now towards its lows, I think.
Yeah, and that's what I'm thinking. Yep. Is it time to give it another crack? And by the way, I've got to say, I made probably the worst mistake I made was with Mesoblast. I bought it on the third leg down, and it had 4 legs down. Right? And it took me a long time to get the money back. Now it's rocketing because you got the approval and its product's being well accepted. Now Telex looks like another Mesoblast waiting to happen, but I've got no other good reason but to say that the consensus view on Telex at this point in time is up 88%. 4 out of 4 analysts like it. But look at Citi. Citi says 133%. UBS says 112%. It just seems like an interesting play, doesn't it? If you want a speculation one to try.
Well, you'd hope the analysts would know a lot more than you and I do, particularly about a company like that. So they're big numbers. That makes it look interesting.
Yeah.
I will, as you point out, it is pretty speculative, and it needs, the trouble with sort of this biotech, meditech, pharma stuff. So much depends on FDA approvals or FDA say so, and you and I can't judge that, right?
Yeah,
it's just
it's a real gamble. It's a real gamble, but when they pay off really, really nice. I don't know. I'm thinking about the people who may have bought Mesoblast at its low. They'd be laughing their heads off. Okay, so there's 4 really good ones. NextDC, Xero, WiseTech, and CSL. And TLX, or Telex Pharmaceuticals, is an interesting speculative gambling type stock. And we'll look at more next week, the ones that look like really good value, because I suspect this negativity will hang around for a while. Trump versus China, rare earths, we've covered that. It's the super tax we want to talk about.
Yeah, this is a total capitulation by the Treasurer. So, a victory for Albo. Albo stepped into this. So don't let anyone else tell you. This is a total cave-in because something like the revenue has gone down from by $4.2 billion over.
So what they're going to collect with the tough ass super tax.
And even in 28, 29, they're only going to be collecting $1.6 billion versus 2.5 under the original proposal. So it's not it's a real back down. So there's 6 changes to it, Pete. So the 2 big ones is the $3 million. That's when you'd have to pay a higher tax rate. That's now going to be indexed.
Yeah.
So that'll go up each year at the same rate they use to index the transfer balance.
So young people shouldn't be complaining.
And they won't they'll have to change the calculation methodology so it won't pick up any tax on unrealized capital gains.
Well, they're the 2 really offensive aspects of this.
They were the 2 bits that people had a point about. $3 million, everything else is indexed and tax, and the unrealized capital gains. So as a result of those changes, 2 other things are happening. One is it's also being delayed by a year. Now they don't.
What's the kickoff date?
So it now won't kick off. The tax won't become effective to the 1st of July 2026.
Yeah.
And what's going to be effective on the 1st of July 25? We just never had seen the final legislation, so it's always going to be backdated.
Yeah.
But it now won't apply to the 1st of July 2026,
right.
Which means you won't actually pay any tax until the 27-28 financial year. So it's based on that year.
Right.
So
when's the next election, Paul?
it'll hit Should it just before the next election?
What year is that?
But the reason
Is it 2026 or 27?
it's going to be at this stage, if he goes the full term, May 28th. So it'll be the
Okay.
time around people are paying this actual tax, right?
Okay.
Maybe just a little bit after, but it'll be fresh in the memories of some.
And they're doing this at a time when they're popular. Susan
Yeah.
May is really struggling.
And the reason why it's been delayed is because they now have to go back to the drawing boards and actually work out how the industry super funds are going to calculate it. That's why I actually picked up the unrealized gains in the first place, because the industry funds couldn't do the calculation. Now they're going to have to go back and give the industry time to actually work out how to calculate the amount of money. But they've said it's not going to include unrealized capital gains. So that's the big change.
But Paul, because hold you on that, because there's not a lot of people that don't understand that when these industry super funds, and I like industry super funds, particularly for people with small balances, I think they've been a great innovation, but they do have non-market testable valuations, don't they?
They do. There are rules around that from APRA. So then when you say things like, they own property, they own private credit, they
own Canva.
Yeah, some own Canva, they own listed shares, What's the value of a Canva share which doesn't trade? Well, how do you work that out?
Correct.
So they have to get valuation. So
and when they're unrealized, Canva's unrealized gain is unbelievable.
That's not the reason why the industry super funds couldn't do it. Because they couldn't apportion that back to the member. Okay. So this is why. Well, sorry, they could apportion it back, but the reason it was going to pick up unrealized capital gains is they couldn't do it the other way. So Sharma's listed that 2 or 3 years ago, went down the unrealized capital gains tax point of view, and now had to reverse it. So the reason for the delay, Pete, is actually they now need time how to work that calculation out.
And Paul, do you also reckon a lot of people say, well, look, you're putting unrealized capital gains on shares. When will it be property? When we pick on?
Well, it wasn't just shares; it was property. It was anything in your super fund, right?
But when
were you doing outside?
Super funds today. What about any investors? Especially investors.
Yeah, that's right. So, and then so that's so the $3 million is index. The unrealized capital gains won't be included. The third change, Pete, is that for people lucky enough to have more than $10 million in their super fund, now they'll pay an effective tax of 40%. So there'll be no value in having super if you've got more than $10 million in it. So apparently there are about 8,000 of those in Australia. So most than I thought. So they'll pay. So effectively what will happen is that people under $3 million, your effective tax rate is either 0 or 15%, depending where you got your money in super or in pension or not. Above $3 million, you pay tax at 30% on the amount over $3 million. And for those with $10 million or more, they'll pay tax at 40% on the earnings.
For those 8,000 who obviously watch our show, I would have, if I had 10 million, watch my show for sure. For these people, is it the 10 million in the super fund or is it 10 million per person?
No, it's per person.
Okay.
Per person. Yep. Sorry, I should have made that clear.
A couple would have to have 20 million to be upset today.
Yeah, I think they're probably on two. Yes, right. If they're about to get it through. So they're the main changes. There's also they're giving some money back to people in terms of what's called the low income super tax offset. But essentially what that means is that people earning under $45,000 or more, their super monies won't get hit with any 15% tax. They effectively be neutralized out. So, so that increases.
It's a soft taxing on super if their income is 45K or less.
Yeah, but they'd always it's a combination of a couple of things. One is that because you might recall Labor went into the government, in the last election with a plan to reduce the bottom tax rate.
Yeah.
Okay. Effectively, what it meant that if they hadn't changed this number, then people would have actually paid more tax for super contributions.
That's right.
Than they would have paid outside. So they've actually what they're actually done is if you have $45,000 or less, and there might be some people here with non-working spouses who've got a part-time job or something, right? What's called the low income super tax offset will increase to up to $810, so you won't pay any money on your super contribution.
And it helps you grow your super.
It helps them grow the super.
Yeah,
No
okay.
doubt.
All right.
So, but it is despite what will be said, it is a total cave in by Chalmers. Big win for the Prime Minister,
Yeah.
and a big win for the industry.
Good. A win for the good guys.
And you've got to hand people like Jeff Wilson have campaigned pretty hard against this, and a few others. So it's still, those with more than $3 million are going to pay more tax than their super. Let's not forget that.
Yeah.
And those with $10 million have got quite a nasty surprise today, right? For a lot of people, farmers, small business owners, people who put their business property in super, and youngsters coming on who would have paid the tax one day. It should have always been indexed from day one.
Yeah.
And I think this is a very sensible accommodation of how they've modified the tax.
Great stuff. Paul, thanks for joining us.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. And before I go to Simon Pressley of Propertyology, let me remind you this. You can get an email from me and my team every day. All you have to do is become a subscriber to Switzer Daily. If you want to get a investment newsletter, you'd have to subscribe and pay for the Switzer Report. But Switzer Daily is something that gives you information about what's going on either in the market or the economy or many other aspects of your life that have a hip pocket implication. So if you want that, you want it sent to your email every day, sign up for the Switzer Daily newsletter. Okay, without any further ado, let's now go to Simon Pressley of Propertyology. Simon, thanks for joining us.
My pleasure, Peter. Always good to have a chat.
Yeah. Now, we've talked about lots of things over the years, and we've looked at, some of the prevailing ideas in the property market. And I have often found that you disagree with like the views that people have about property. And so today I want to actually talk to you about what is it you think people get wrong and what is the right view to have about property. And let me say, concentrate on your beloved Brisbane, because it's seen as being a good place to be. It's had a good run for the last few years. Tell me if I'm wrong, but it seems like Brisbane's been a popular place to be. At one stage, I thought there was a bit of like a commitment to that great march into southeast Queensland when Peter Beattie was Premier and prices were going through the roof. And you might tell me well, it was wrong, but it just seems to me, and let's face it, 3 or 4 years ago, Brisbane really did look fantastic value. I was watching those shows, Love It or Listed or whatever it might be. People were selling in Melbourne and then buying great places in Brisbane with pools just like you, all that sort of stuff. So put us right when it comes to understanding how you make money out of property.
Yeah, contrarian, I think, is what you describe me as, and I get that a lot. It's not at all that I like being different. What I like is understanding the cause and effect of things. Someone once described it as the science brain. I'm not a scientist, but it is important to me to understand the cause and effect of things. And my role, regardless of the fact I live in Brisbane, my role is to look at each of the 400 towns and cities across Australia every single day and understand what's happening, mostly with their economy, because evidence-based studies have taught me that the cause and effect of property market performance is mostly influenced by economic performance of that individual town or city. So that's why in almost every single year, Peter, there'll be some parts of Australia that might have had 10 to 15% increase in median house values. There'll be some other locations that had no increase at all. And there'll be some others that have gone backwards. They've all had the same interest rates. They've all had the same prime minister, but yet their property markets have been very, very different. So it's an economic story. But what I know, I've forced myself to gather the evidence and study it for years and years and years. Now, there's nowhere in the world that people can elect to learn that. There's no university degree or course that I would describe as good quality information or a book that I would describe as good quality information. So that's, I guess, why I see things differently. It's because it's very much evidence-based learning.
So, we see every month The newspapers, the chief economists, they look at the house price changes on the month, and they look at the annual change. How important is that as an indicator for anyone who is either wanting to buy their first property or be an upgrader or be an investor? Really, what do you think about that as an important indicator?
I think it very much depends on whether you are buying to live in the property, that is a home, or whether you're buying it as an investor. If you're buying an investor, you need to have more the mentality of the share investor, and you need to disregard home, and you need to see property as a financial instrument. If you're looking to buy a property to live in, whether it's your first home, whether you're upgrading to something bigger or nicer, or downsizing because you're an empty nester or whatever, I would say it's largely irrelevant what's happening in the world. Because what's most important for the home is what's going to make you happy. And the town or city and the individual property within it is very different to what makes Peter happy, Simon happy, or Bill Bloggs happy. If you are an investor, you need to totally disregard where you bloody live, and you need to forget about the bricks and the mortar and the capital city versus region and coastal versus inland. And you need to learn from the evidence-based studies I was talking about before that we've got 8 capital cities and 400 regions across 8 states. And what will have the single biggest influence on property market performance is the actions that influence the economy of each of those towns and cities in the future. So I really don't care about, for example, an unemployment rate. Right? That's irrelevant to me. There's lots of different ways of measuring an economy, but at the end of the day, there's a big bunch of decisions that different stakeholders of a community make: federal government, state government, city council, existing businesses, China, Japan, America, etc. There's lots of decisions that are made each year that have an impact either on job creation or job loss. And they're the things that people need to focus on, not bricks and mortar and train stations and shopping centres and cafes. Those things are important for home, but have nothing at all to do with market performance.
Okay, so you said there's effectively 400 economies to care about because there's
Yeah.
400 cities and towns you watch. And you said that unemployment's not important. And I guess here is a question relevant to all this. And when people ask me, when do I think house prices will fall? I usually say, well, if we saw unemployment at 10%, probably we'd see a lot of house price falling. What do you reckon? I'm saying as an economist and as a historian as well, the last time we were 10% house prices, they fell, but they didn't fall by a real lot. I'm talking about 1990, 91, unemployment got to 10.4%. That was national. Around the country, it's probably even higher in some of those places you're talking about. But we need a serious spike in unemployment to see pretty well a national fall in house prices?
Yes, but it's not about a specific figure of 10% unemployment or 7% or anything like that. It's job creation and job loss, and more what the trend is doing. I mean, obviously, now and for the last sort of 5 or 6 years, Australia has enjoyed incredibly low unemployment rates, and I broadly think that's likely to increase, but nothing alarmingly. But it's only going to have a tangible impact on property markets. And again, it's not about the Australian unemployment rate or the New South Wales versus Queensland unemployment rate, because you can't actually buy property in an Australian property index or a New South Wales property index. It doesn't exist. So it's about the individual town or city. But if there is a significant increase in jobs or a significant loss in jobs in an individual town or city, it will directly flow through to the property market performance of that individual town or city.
Okay. Simon, you probably remember when Bob Carr was Premier in New South Wales and Michael Egan was Treasurer, they introduced about 3 taxes that really hurt the property market. And Sydney house prices went sort of sideways for, I can't remember, but it seemed like 3 or 4 years, could have even been longer. I remember interviewing John Simon for a big Commonwealth Bank conference, and at the time, it was going sideways. Can you recall that time? And can government policy have a big impact on a capital city for a period of time?
Definitely, state governments can and do regularly. They have a lot more influence on property market performance than federal governments, because they have a lot more power. COVID was a reminder of that. What ScoMo wanted to do in COVID was overruled by what the Premier I wanted to do and did in fact do. It's the same with economies. States have a lot more taxes, particularly property taxes, and they have a much greater influence over things like infrastructure investment and broader economic policy. Right now, for example, the state of Victoria, most people would be oblivious to the fact that Melbourne's median house price today is only 3% higher than 7 years ago. Over that 7 years, is parts of Australia where house prices have doubled, right? Melbourne's had 3% growth in 7 years. There's no coincidence that the whole state of Victoria has been an economic basket case for much of that period of time. And the biggest influence over the current economic basket case is a long suite of really poor decisions made by the Victorian state government. Every state in Australia has had periods, sadly, like that. This time 10 years ago, Western Australia was entering economic doldrums. Queensland and South Australia weren't doing much at all. Their economies. New South Wales had periods before where their premier was like a revolving door. I think you had 6 premiers in about a decade or something like that. So the performance, good or bad, of a state government has a very, very big impact on the broader state, not just the capital city, but the broader state's property market performances.
Yeah. How important is the poor supply of houses nationally important to the fact that we've had big rises in house prices nationally?
That is very important. Like demand, supply and demand are very misunderstood with property. The masses believe that demand is population growth. It's not. Whether we're talking about property, food, clothing, or cars, and demand is a human electing to use money to buy something. And most people who buy property are already living there. It's the existing resident population who transact in property most, not the 50% of increase in population each year. On the supply side of things, I think a lot of people think that's all about how many new homes are built. It's part of the equation, but the single biggest influence on the supply side of property market performance is how many properties are listed for sale. Most properties that are transacted in any town or city in any year, Peter, are an established dwelling, whether we're talking about an owner-occupier or an investor. When they work out exactly what is it that I want to buy, more often than not, it's an established dwelling somewhere that ticks the boxes they're looking for. Now, right now, Australia today has 25% less properties listed for sale than this time 7 years ago. We've had a 3 million increase in our population over the last 7 years, but yet there's 25% fewer properties listed for sale. So what that means is if you're a buyer, investor or owner-occupier, doesn't matter, it's all competition at the end of the day. If you're a buyer, you're competing much harder than you used to because there's fewer properties listed for sale. The governments can do whatever they want or say whatever they want in terms of building more. Evidence suggests that governments only themselves fund about 1% of new properties each year. It's the private sector that fund them. But at the end of the day, it's the general public that buy them. So build very little or build a lot. But if the buyer doesn't want it, whether it's new or established, they won't buy it.
Mm. What do you think about people who say to young people, look, rent where you want to live and then invest where you can make some money, well, where one day you might want to live. But at this point in time, you can't afford to live there. Use a tax office to help you pay for it. What do you think of that strategy?
Yeah, it's become increasingly common, but particularly for the person who might be, I'm generalising here, but someone in their mid-30s who lives in a very expensive city such as Sydney. It's not that they don't want to own a home, but we're talking about earlier, the supply and number of properties on the market. So when they look at what's available and then compare whether they want to live in it and can they afford it, they quickly conclude, no, I can't. But it doesn't mean they can't buy a property, right? So rather than have, for example, $100,000 cash in the bank saved as a deposit, and then sort of feel depressed that that's not enough money to buy the 3 or 4 bedroom house in Sydney that they really want to live in, there'd be somewhere in Australia that you can put that $100,000 into a property, hopefully in a well-chosen location, considering all those 400 towns and cities. And if you get that decision right, $100,000 combined with the debt is going to grow at a much bigger rate than what that same person can continue to add their savings to. So it's called rent vesting. As I said, it's very common for that middle 30s couple, but it's always been around. There are some occupations who need to be more mobile for career progression. That think of the military or engineers or something like that. They might not want to anchor themselves to a particular city and buy a home in it. They might be happily renting because renting means they've got the flexibility of moving, so they can move around to wherever they want with their employment, but they still own property. They just don't have to be living in that property. They might have a property portfolio, 3 or 4 properties spread around Australia.
Mm. What about investing in property in a self-managed super fund? I know 8 years ago it was very good. There was no interest rates were quite good. There was less government impositions on people doing that. What do you think about nowadays? Self-managed.
There's nothing wrong with it. But people still need to know the rules. Just because someone can set up a fund, it doesn't mean that they should. There's no law stopping someone setting up, but do they have the skills? I'm a big advocate. If they're going to set up a fund, you still need to have a really, really close relationship with a trusted financial advisor, and lean on them to make good quality decisions. There are a lot of people who set up self-managed super funds, and then the money burns a hole in their pocket, and they make some pretty reckless decisions with the property that they've sold. So the property that they bought. Well, I think one thing that people who enter the self-managed superannuation space need to be more aware of is the annual holding costs of buying a property through a self-managed super fund compared to buying that same property in your own name. The difference is significant. A self-managed superannuation fund must have a principal and interest loan structure, whereas most investors in their personal name will have it on an interest-only structure. And then the interest rate itself, the self-managed super fund loan typically has an extra 2% buffer. So a stereotypical property owned outside super might cost the investor, let's say, $15,000 to $20,000 of their own money per year. That same property inside super is probably going to be about $35,000 that the fund has to find. So that catches a lot of people out.
Can you run through what you hear out there that's being peddled in the media that people should understand about property, where you say, oh, no, that is just wrong. That is wrong. If people believe that, they're going to be making the wrong decision because of that.
Population growth is the most common one, and I think I've done that to death on your show. So your listeners will be aware that population growth has a very, very small influence. The next biggest myth would be that capital city and region have something to do with rates of growth or something to do with risk. It doesn't. They're just useless terms in terms of markets and in terms of performance. There are some regions that are high risk, and I would discourage anyone from investing in. But there are dozens and dozens of them that actually have a lower risk profile than 8 out of 8 capital cities. So it's got nothing to do with capital versus region. It's like a share investor saying banking stocks are more risky than a tech stock or vice versa. Well, which banking stock are you talking about, and which technology company are you talking about? So that would be the biggest. And then because we live in property, a lot of people's perceptions are based on how they feel themselves. So the person who likes being near water, for example, I do, but I also know that water has nothing to do with property market performance. A lot of people who like water will end up buying somewhere near the water, thinking somehow that's going to make it grow more than if they bought it in an inland location. It has no bearing on it whatsoever.
The fact is, people all want to live near the water, and most people do. Are you arguing that they pay a higher price to get in there, and then as a consequence of that, the growth is not all that great compared to an inland place where you might buy cheap?
Well, I think if we did a survey of 27 million Australians, a very, very high portion would say, yes, I do. I would prefer to live in the water. But then if we did a separate survey and said, well, are you actually living there? Most people wouldn't, right? So there is a difference between a house that literally is on the coastline and bang, they can see the blue water, 24 hours of the day, compared to someone saying, look, I live in Sydney, and Sydney is technically a coastal city, but my home is in Penrith, right, which is a long way near the beach. So water doesn't It doesn't have anything to do with the market.
Okay. When it comes to stocks, I love buying great quality stocks when the market hates them. Like at the moment, I like CSL, and I like Zero, and I like NextDC, because the market at the moment is being negative, but they're quality companies. Now, Byron Bay, it's got quality assets often, but at the moment it's come off the boil. But before then, it was really rocketing, wasn't it, during COVID and all that sort of stuff? So is that a good place to buy when it comes off the boil because of prices are high or interest rates are rising? Can you apply the same kind of principle to properties when prices are falling for good quality areas?
In a word, no. Yeah, well, but main reason being is property is not tradable like shares are, right? You and I know that we can press a few keys on the keyboard and we can buy or sell some stocks with it literally in seconds. Property's not like that. Market performance is probably think more like not the share value, but think about the profit loss statement of a company or the performance of a footy team. Property market performance, it's a sum of the inputs. There is no, markets don't bounce in property. They can in shares because sentiment can drive stocks up or down literally within a few hours. But property markets don't do that. It's all those economic inputs. And most of those things that have a big influence on market performance, there can be a lead time of several years. So, I wouldn't encourage anyone to be buying properties that way.
Okay, last question, and this really relates back to what happened in the GFC. In the GFC, Palm Beach, before the GFC was just, Palm Beach in Sydney was rocketing. Values were really high. And then the GFC, a lot of the people from Macquarie Bank and BT and all the other big investment banks were in trouble and prices fell. They fell really hard. You might recall that.
Yep.
A city that has often been like has been the Gold Coast. Up one day and really could fall. But Gold Coast seems, and you can correct me if I'm wrong, seems as though it's got out of that boom and bust cycle. Is all the things I said true?
Yes, it is true. And back in the day, Gold Coast, look, for a long time, it's had some economic diversity, but nowhere near enough for Propertyology's liking. And the problem with a town or city, if its economy depends too heavily on one key sector, whenever that one key sector has a downturn, which often is globally influenced, that city that depends on it more, its property market suffers more than somewhere else. So Gold Coast is an example of a city that now has incredible economic diversity. But if we went back to, as early as, say, 2005 and every year beyond that, it depended too heavily on tourism. So when, and tourism's a discretionary expense. So when broadly the Australian economy is good, people are holidaying the Gold Coast and the local economy is doing well. But when the GFC hit, which is a great example you use, discretionary spending tightens, people don't go on holidays, Gold Coast suffers. A modern day example of what you're talking about there is Perth. Perth has some economic diversity, but it depends too heavily on mining. So whenever it is the mining industry has a downturn, which it will at some point down the track, whenever it does, whilst the mines aren't in Perth, tens of billions of dollars of revenue comes directly from mining royalties into Perth's economy every single year. So, economic diversity is the single most important thing for mitigating risk as a property investor.
And people who have bought, what's that big area south of Perth, begins with Mandurah, exactly. Mandurah. People have bought there low and have absolutely killed them when the mining boom's on, and then it's really fallen, hasn't it? There's a classic example of they're good quality assets, but you have to buy them at the right time ahead of another mining boom, and they go up in value quite extraordinarily.
Yeah, and with 8 billion people on the planet, Peter, there's no individual who's got any way of knowing when each industry sector is going to have its downturn. So anyone who's got some interest in investing in property, don't pretend that you can predict what industries are going to have a downturn. Be more sensible and only invest in towns or cities that have significant economic diversity, and make sure you're aware that capital city or region has nothing at all to do with economic diversity.
Yeah. I remember at one stage, and you recall this, where I think apartments in Gunnedah were unbelievably expensive because the coal mining industry was absolutely killing it. And once everyone started hating coal, guess what? Gunnedah was a very cheap place to buy.
Yeah, that's a good example. It's not coal or mining that made the boom. It's job creation. It's always an economic story.
Yeah. Simon, thanks for joining us, mate. Great
My
insight.
pleasure. At any time.
And that was Simon Pressley of Propertyology. And remember what I said earlier, if you want information sent to you on a daily basis to give you a competitive edge when it comes thinking about the economy, investing, making money, you should become a subscriber to Switzer Daily. And if you want information about stocks, you should sign up for the Switzer Report. We're talking to David Burton, Dr. David Burton, who is the CEO, and David Lawson, who's the CFO. So the company's been around for a while, and it's in the sleep space sector, an interesting little company worth considering. I think before we start, Compumedics, the company's been around for a long time. I've interviewed you numerous times in your listed corporate life,
In a couple times.
a couple of times. Explain to the audience what you actually do.
Okay, we're a neuro and sleep diagnostic company. And in particular, we've developed a couple of breakout areas. One is in the new AI sleep space, which last time we were talking about just starting that.
Yeah.
And the other one is in the brain scanning space. Last year we did about 51 million in revenues. This year we're slated for 70 million
Yep.
with a 9 million EBITDA. And it's primarily these days more remote and home monitoring. And our traditional background has been capital equipment in hospitals.
Yeah, there's like contraptions on people, and you could actually analyze what was going on with their sleep.
People with sleep problems,
Yeah.
which is a good portion of the world.
Yeah.
Is a third or more of our business.
Yeah.
And the other parts of our business are neurological disorders.
Yeah.
A lot of those too.
Okay. Well, I'm going to get down to, the performance of the company, and we'll pester David on those areas, and you can chip in if you think he's wrong. But
Keep an eye on it.
and I always ask questions about what my viewers are thinking. How are you different or similar to, say, ResMed, which is clearly a rival in some respect?
Yeah, absolutely. Well, ResMed's a treatment company.
Yeah.
And it's an enormous company with their CPAPs.
Yep.
Doing a great job, by
Yeah.
the way.
Yeah.
And we're a diagnostic company. So we provide the first step in the chain, if you like,
Yeah.
in terms of the identification of sleep disorders.
Yeah.
The large proportion of sleep disorders, I guess, impacting both ResMed and Compumedics, are things like apnea, which has symptomatic snoring. It also impacts, if you have sleep problems, especially respiratory sleep disorders, impacts things like heart disorders.
Because there is a strong link, isn't it?
Well, there is.
Sleeping patterns can either lead to or do they reflect a heart problem?
Yeah, well, for example, we were chosen for the Sleep Heart Health Study, which is a textbook-based study on the linkage between cardiovascular disease and sleep.
Yeah.
And it shows that elements such as over half people with sleep disorder breathing also have congestive heart failure. And 70% or more of people with first stroke sufferers also have sleep disorder breathing. So an incredibly tight link.
Yeah.
And people need to be conscious of being diagnosed in the first place and then treated in the second in order to avoid those latent disorders of the heart.
And this is a question, I guess, like I implied before. Is it one causes the other? Like, I'm sleeping badly and that leads to heart, or is it a problem with the body, but at the same time you've got a heart problem developing, and at the same time your sleep becomes worse as a consequence?
Well, a lot of medical disorders and symptom cause, they're interlinked.
Yeah.
But generally speaking, what will occur and why we're in business as Compumedics is we'll diagnose people that have cessation of breathing during the night, and that changes the ventilatory function of the body and the cardiac function. And the heart can be forced to work a lot harder if you're not breathing properly. And the reason that occurs with a lot of people is there's a sort of a partial or total closure of the breathing pathway during sleep when the muscles relax and the body changes. And that leads to latent serious cardiac disorders, which is why more and more people are being diagnosed and treated.
Okay. Historically, you said you worked in hospitals or with doctors, and you said now it's can be done more.
No, we still have a strong capital equipment business,
Yeah.
but we've been focused at an early stage on being product services driven.
Yeah.
And that's why we've now had a business which has gone from about 0 to 7 million in a few years, which is our SomFit business, which is a wearable home sleep that uses a SaaS model and AI. And that's growing quite rapidly in that AI sleep space. That tends to be the higher growth. The background was predominantly hospital and associated sleep services,
Yeah.
but the whole market has shifted, and logically so, to be able to conduct many more home sleep test studies than occurred even a decade ago. In fact, probably a decade or so ago, over the half market would have been hospitals. Now we've got, or the majority of the market would have been hospital-based studies. Now we've got the majority of studies are home-based sleep services.
So for someone listening to this and you're talking about this can be done at home, does it require some kind of device that links to what your mobile phone and then goes to
Yeah,
some other breathing
to give you the case with our SomFit system,
SomFit? Okay, yeah.
There's two versions now. One's a disposable, which is just the one we're about to release,
Yeah.
which is a much bigger market in countries for disposable monitoring. And it effectively sits like a Band-Aid on the forehead
Right.
with a monitoring system that links to the mobile, which then interfaces with a cloud function.
Yeah.
But the doctor virtually immediately has access to the data,
Yeah.
and the next day that with AI can be analysed. And generally in our systems, which are different than most of the home wearable SaaS systems, ours measures the brain function as well. So you get the breathing, sleep disordered breathing,
Yeah.
as well as the neurological function,
Yeah.
which gives you the quality of sleep.
Yeah.
And of course, the brain restoration is an important function.
Does it pick up on, this is something a lot of us wouldn't know, right? I've only picked up this in recent times. When you talk about arterial problems, you always think it's the rest of the body, but
Yeah.
there are arterial problems in the brain as well, that if you've got problems in the rest of your body, you could have problems in the arteries in the brain, and that could be stroke.
That's right. Well, exactly. But for example, Alzheimer's. I forgot what I was going to say from that. But Alzheimer's, for example, that's a function where it's now known that there's a vascular function which actually operates during sleep,
Yeah.
and particularly deep sleep,
Yeah.
which generally flushes out a lot of the toxins of the brain. And one needs to measure and make sure we have the right structure of sleep in order to avoid that lack of restoration of the brain. Otherwise, you get that cumulative effect. So there is crossovers there.
Yeah.
And yes, that's one. Now with stroke, or you mentioned there like stroke, that's generally because if you have cardiac disorders and vascular function disorders, then of course your heart is working overtime, and you also can have a adverse impact with something like stroke, which is of course linked to the vascular system.
Okay. This Band-Aid on the head, SamFit, was it?
SomFit, yeah.
SomFit.
SomFit, yeah.
Is this going to be a game changer for the company, do you think?
Well, it has been. Give you some context on it, like one of SaaS companies, particularly AI, their valuations, you would have seen one recent times, is legal AI. They range from about 20 to 70 times the revenues of a business. Unbeknown to most is that we've taken our 7 million AI sleep sector of our business from virtually zero. And interestingly enough, when I last met you behind the camera, we were talking about that as a concept.
Yeah.
It's now a 7 million business, and it's growing at a rate which is 50 to 100%.
Yeah.
So it'll become logically and rightly a vast proportion of our business, but also the value, because it's very easy. You can make a phone call, a doctor, and overnight attach this to your forehead. And as I say, you've got the AI sleep study the next day or so.
Yeah. How's the cost to get the contraption, the Band-Aid for it?
Well, in America, these studies are, of course, reimbursed driven.
Yeah.
So for many of the patients,
Yeah.
they don't pay anything.
Yeah.
And that's ultimately what's helping drive it too.
Is it happening in Australia like that?
Yes.
It is.
To a lesser degree, Australia's Medicare have decided that they don't accept the reimbursement like they do in America with millions of studies.
Yeah.
And, So it seems to be a little bit outdated on that function, but I think they'll catch up.
David, what's the reach in America like right now for Compumedics?
Well, the US business has gone from $6.7 million of revenue in FY24 to 13.6 million last year, FY25, and we're looking to push through $20 million this year. So the US business is a big part of our growth platform.
Yeah.
And the reason it's so is because there's 60 to 80 million Americans suffer some form of sleep disorder, which go undiagnosed each year.
Yeah.
There are about 4 million sleep studies that are done through a year through the traditional sleep lab based business, and there's now about 4 million studies a year done through home sleep testing. But the home sleep testing market is growing at about 25% per annum. So there's significant opportunity for us in that market. I think, as David said, we have the SomFit device, which is reusable. And then we have SomFit D, which we just got FDA on, which is our single-use or disposable device, and that's much more suited to the US market.
Investors in, biomed companies always fear those letters, FDA. And so have you passed FDA hurdles?
Yeah, well, we've been doing it for 20, 30 years. So we got FDA clearance for SomFit D 2 weeks ago, about 3 months ahead of when we thought we would get it.
So putting that in context, we have a $19.5 million pipeline driven primarily by the SomFit D, which only recently received FDA. Surprised us a bit as well.
Yeah.
But that gives you a perspective. 20 million, look at our total revenue of 50. And then you look at the companies, probably viewed by most investors still has been a capital equipment company, clearly not the case.
Yeah.
And FDA driven.
Okay. So do you have a potential Trump tariff problem?
No, look, the tariff is 10% between Australia and here for us. So, to the extent that we have put our prices up in the US, we have done so. But our competitors are in the same boat. Itamar, for instance, who was a major competitor in the home sleep testing space, is based out of Israel, so they do their manufacturing there, so they face a much heavier tariff. Even the local manufacturers in America are still facing tariffs on their raw materials coming in. So I think everyone is struggling with the same thing or adjusting to the new landscape.
Probably has less impact where there's premium innovation factor. And in ours, the majority of the US equivalent monitors, in fact, the major competitor, it's a finger-based. So it doesn't give you, for the same attachment, similar invasiveness, doesn't give you the actual brain function. Discussed how important. So we are able to command a innovation premium in that context.
Yeah. Is there like an equivalent? I presume there is. AMA in America. Have they looked at your product? And, in a sense, the more GPs would want to use it, the better it's going to be for your business. Is that right?
Well, America's an interesting industry. It's home-based sleep facilities. They are the dominant centres, and some of those can do 200,000 studies a year, and they tend to run the masses of the studies in US with their reimbursement. And out of those, we've now got 3 or 4 of the top 5 or 6, and we've achieved that since first FDA with SomFit 12 months ago. So we're cutting through mainly because when someone uses our system, they can also measure insomnia studies as well as the apnea. So you've got the broad range. So we're in that space, and we're the only one in that space in that top tier.
And I always have to be nastily honest. And I looked at the share price, and there's been some great price surprise. Well, there'll be viewers out there doing exactly that.
They're disappointed in you.
That's right. So there's been some great peaks.
Yes.
And you've kind of struggled over the last few years.
Yes.
Are you expecting these new developments? I don't think you haven't marketed heavily the new development, or have you? And I've just missed it.
We haven't marketed heavily yet. We have our ASX releases out there,
Okay.
and the
That's
revenues
simple to sleep, of course.
and the revenues and the earnings are still to come. The market will catch up.
Yeah, so it's and we are, and generally speaking, I don't cover companies with blue sky futures. I have historically in the past. I always thought you guys would really shoot the lives out, but I guess that's a fair question. Why didn't you shoot? Why didn't you shoot the lights out? Because it was always a great concept, and that was a reason, and it's an important issue. Lots of people have sleep apnea. A lot of men in particular ignore it.
Okay.
What's been the struggle, and how do you think you're beating the struggle now? The obstacle to your
I guess the first thing is we've been traditionally a capital company.
Yeah.
And they've
always
been able to
hard.
trap low multipliers
Mm.
because you're competing with manufacturing more than the intelligence front.
Right.
We've now transitioned and transformed. And 2-3 years ago, our SaaS component was 0.
Yeah.
So when we were talking about shooting the lights out, we were 0.
Yeah.
Now we're 7 million.
Yeah.
And it takes time.
Yeah.
And the other factor is, I guess, I take full responsibility. I need to resolve the arbitrage between our peers, the 4 times value of equivalents in US markets, and that's 4 times annual revenue. And if you look at the SaaS market, that's the sleep AI, we're talking 10 up to 70 multipliers.
Yeah.
As an Australian company, we probably won't realize that until we become more US orientated, where our competitors are and where the investors are. That's why recently we announced a new board strategy. We are, for the first time, bringing on US-based executives. The gentleman on there now has scaled up 2 or 3 companies to over $1 billion, worked for Johnson & Johnson, Medtronics, and has that ecosystem connection. And we'll probably be bringing a number of those players on to try and fill that arbitrage so the value is realized. But we are, there's a question, are we undervalued? I said to answer that by opening up the American market. That's my job.
Okay. Well, guys, we keep our fingers crossed for you. Dave, is there anything else you think that a potential investor, not that I'm encouraging people to invest, because I don't know their circumstances, but is there anything else that I haven't covered that is important to get out there?
Well, I think there's a couple of things. First is the SomFit. We've just spoken about the home sleep testing market for sleep apnea. There are adjacent markets into big pharma. So the big contract research organisations have bought SomFit because of the direct measurement of EEG channels off the forehead. I think Europe is still a big untapped market for us, both for SomFit and for the existing capital business. And just to reaffirm our Asian business as well, we've been in Asia and in China for 30 years. And, despite the geopolitical shifts here and there, we are continuing to build the business up. So it has been a focus on America, but the business is a global business.
Good question. When we last met, we hadn't scaled SomFit. In fact, it was a concept.
Yeah.
And we hadn't scaled MEG. Well, as we sit here now, in the startup phase of MEG, Peter, to answer your question directly, we've sold 20 million of MEG in China alone. And we're going to release in America, the biggest market, in 2026. So the lights are still there to be shot out.
Yeah. It's funny as I listen to you and as David, sneakily crafted his CFO type talk. It's obvious to me and people listening, hey, this could be a takeover target from Big Pharma. And of course, that's a nice, but all biomed companies are in that kind of potential class. You really want to kill the market.
Peter, in the early 80s, there was 100 MRI systems. Today, there's 34,000. They're a general metabolic system. Ours is for the brain, autism, Alzheimer's, epilepsy. So if we get a strategic partner, which is why we're opening the board up, then you're dead right. Both for the MEG brain scanner, the Orion brain scanner, which is sold to 20, and for the SomFit. But we need to find those partners, and that's why the Compumedics is changing and bringing a greater depth on the board that taps into the US eco investor system. And it's our next step.
One final question before we finish. We've seen the big tech companies like Apple and Google getting into the alert issues around sleep apnea and stuff like that. Is this a problem for you, or is it an opportunity?
I think it's a terrific advancement. So firstly, companies like Google, Apple, you've seen they're the big investors that invest in vertical integration opportunities, but they generally don't change their core business because they've got a specific role and a focus. And we may produce an opportunity. I'll give you an example. In Australia, 75% of the pharmacies in Australia now utilise for its sleep service Compumedics on-fit. And that's in the space of a couple of years. And that model can be reflected in a large scale in the consumer, potentially with a Google, Facebook, or Apple, as it can in the US pharmacies. So it is widening the funnel, and we see that for a specialist company that has the vascular for the apnea and the insomnia working right now at the top tier is a good example.
And I guess the bottom line is this, that 20 years ago, when people talk about sleep apnea, the man in question was said, that's not real. I'm just snoring.
Yeah.
If my partner can't take it, too bad for her. But now they realise that it's not only annoying their partner, it could kill them.
Yeah.
And the more, I guess, people are alerted from their phone or their watch, then they might have to go and seek out some real serious, and these big companies are never going to be really delivering the serious solutions, but they could alert a lot more potential customers, I guess.
It gives a pathway for everyone to have their first test at a consumer screening level versus going through a lifetime of cardiac or neurological disorders or respiratory disorders.
Unknown. Great. Thank you, guys. That's David Burton, David Lawson of Compumedics. Thanks for joining us. I'll see you next week.